Welcome back, everybody, to the CD Financial Podcast. CD Financial, where health meets wealth. I am Marcus C., your host. The man across from me, as always, is Chuck D. Chuck D., my man. How you doing?
I'm doing good. I'm tight. Everything's rolling forward.
Excellent. Tight and rolling. I love it. That's good. Let me ask you something. Every time I come out here to California, and I love hanging out in Southern California, because 12 months out of the year, you got 72 and sunny, right? Like, do you ever just get sick of that? Do you ever just say, I'm going back up north because I need to know what it's like to slog through snow and shovel out my car?
You know, it's funny. Sometimes if I get too many sunny days in a row, I don't like it. I need to see clouds. I need to see variation. Living by the ocean, we have a microclimate that rings around our neighborhood. Yeah. And so it holds a lot of gloom till about 10:30 or 11. And I'm comfortable with that gloom in the mornings because I'm from Pittsburgh.
I was about to say, spoken like a Pennsylvania boy.
So I love our microclimate. It's like it drew us to a perfect neighborhood, right?
Yeah.
And my wife found that neighborhood when we first moved here 16 years ago, and it's good for us. Yeah. All right. I love it. Yeah. It burns out. The marine layer, the fog burns away about, I don't know, 10:30, 11. Some mornings it starts out sunny, of course. Sometimes the clouds are below and above. It's pretty cool. Yeah. Some of the effects you get from the ocean and living in the hills, it's super cool right above the ocean. It really is.
Very nice. I know. I
don't miss wet feet and slush. Slush when the snow starts to melt and shoveling. I didn't mind too much, but I don't like the transition in that, the upper 30s, lower 40s weather temperature wise. I don't like that.
Yeah, because it's damp and you still feel it in your bones.
Yeah. It's a lot colder back east than it is in the Rockies where it's arid. The weather's cold but arid. It's not damp.
Yeah.
Everybody will tell you that. Yeah.
That's what they say, right? Like you talk to someone from Arizona, it's 120, but it's dry heat. It's dry heat. Yeah. No, it's 120, man. It's hot. I will say this, living in Texas, especially like when you go through a tough summer, there are days when I just wish it was 20 degrees and, had a little bit of that. But I think overall, like you, I take it in bites. So that's good.
Yeah, absolutely.
But you need some gloom, right?
You gotta have some variation with your weather.
Some rain
clouds,
to appreciate the sun.
Yeah, that's what I appreciate about SoCal, right?
Yeah.
Yeah, and I enjoyed sometimes those winter days in Texas when I lived there.
Yeah.
Sometimes they would be 65, 62 degrees, 70 degrees and sunshine, right?
Yep.
And then you get a bunch of cold rain too.
Yep. Yeah. It makes you appreciate things.
Yeah, it keeps you honest.
I don't know why that occurred to me. I was just thinking about that because every time I come back here, I think, how do I pack? How do I pack? It's 72 and sunny. How do you? What's the dilemma, right? Excuse me.
Got you all choked up.
What's the dilemma, right? It's 72 and sunny. It's a couple pairs of shorts. It's not difficult.
I mean, I wear a jacket. You don't because you're used to a little crisper, colder climate.
I like it. Yeah. I like it. So good. All right. Well, as always, I'm happy to be sitting here with you, picking your brain, talking words of wisdom. And today's topic is of interest to me because a lot of times when we discuss things, we talk about having someone on your side who's a professional, who can help you, right? We've discussed having someone who's outside of your family environment who can guide you without emotion, because a lot of times we're discussing money, there's emotion involved, but you got to detach yourself emotionally to make wise decisions, right? So it's good to have someone guide you through. So DIY efforts aren't always the best when it comes to retirement and financial planning, right? Am I right? I mean, what's your experience? Do you find that people DIY it well or not so much?
Okay, so Mark is talking about do it yourself.
Yes.
So a lot of folks don't have a choice there.
Yeah.
And so sometimes they do it very well in the do it yourself. When it comes to, I'm going to point this out.
Yeah.
When it comes to their retirement savings,
right.
What I mean by that is TSP, 401k. When it comes to having your job and the retirement savings plan at work where they're matching your dollars, some folks do a very good job of it. Especially, I would say, at the TSP because there's only 5 funds to pick from. And sometimes that simplicity really enables folks to do very well because they're keeping it so simple.
Right.
401ks, they get a little more advanced with some of the choices oftentimes. But again, you can do a good job there.
Right.
Yeah. So What is the question?
So let me tell you why I mentioned the whole DIY, the do-it-yourself thing, because and I agree with you. I mean, there's a certain road you go down, and it gets boring. Let's be honest, it gets boring to do the same old thing, and sometimes people get creative, a little frisky, if you will, and think, you know what, I should start taking money and go play in the stock market because I could make a killing. So my question is, and what I want to talk about today is, should I get involved? And when I say I, not necessarily me personally, but just in general, should I just kind of get in there and start buying some stocks and get involved with the stock market?
Should I get involved in the stock market?
Yes.
That's the question.
Yes.
Okay. That all depends on what that question means to different people.
All right.
Some people means they should take their savings account and start buying actual individual stocks.
Right.
Maybe penny stocks, maybe, I don't know, Bitcoin, or whatever that means to different people. I don't know what that means. I would say that in all stages of your life, it makes sense to have some portion of your portfolio in the stock market.
Okay.
But I don't know what that means to some people when they hear that. When I say all stages of your life, in retirement, all our client families have money that's in the stock market.
Right.
But is it in any one individual stock that occupies 30, 40, 50% of their portfolio? No, never, right? Because that would take on a single stock risk, which can be really risky, no matter what the company is.
Okay.
I'm thinking about a gentleman that I know, and he wanted to talk to me about retirement planning, and I knew him socially and from the congregation. So we had the conversation about creating a retirement income plan. And he was involved as an engineer in a very large and famous aerospace company. Did I say famous?
Famous.
A very large and famous aerospace company.
That would be the most famous of all.
Yeah, and he was an engineer from, he was a foreign-born, moved here as a young man, as an engineer, and started his career with them. And he said, no matter what happens, I'm going to lay it all on the line with their stock. And that's what I'm going to buy. And he ended up being quite successful. I would say he was a multimillionaire, let's say. Until that one stock went south, right around COVID, and sort of remained there. And so at its height, I remember talking to him and just suggesting, let's say there was $4 million, okay? Out of that account, why don't we at least, because he was so adamant about having the company stock, why don't we at least take 25% or $1 million off of that risk and diversify?
Get all the eggs out of one basket.
Yeah, because it was absolutely in one stock.
Yeah.
That's a lot of risk. And he could not see the forest through the trees. Here's the other problem. You can invest in the stock market, let's say, as he did with one individual stock. While you're young, that may not be an issue. But when you get older and you're going to retire, at that point, you might want to enjoy that money.
Yeah.
You might want to have access to it. And at that point, if you don't make an adjustment recognizing now your risk tolerance is not what it used to be, because you're no longer 30 years old or even 40. Right. Now you're 65. If you want to go and turn to use that money, and your money went from, let's say, $4 million to 2.7 or 2.5, you may not be interested in touching that money. And now for the next, who knows how long it could take for the stock to rebound. For the next 4, 5, 6 years, your money may just stay there. And it could stay at that, I'm illustrating this, folks, at that like 2.7, and you could be bitter and you don't want to touch that money. So, Mark, that's why I see folks with large TSPs or large, generally north of $1 million and well upward, and 401ks, as they get close to retirement, what they do very often. I rarely see them continue to just keep it right in the C fund,
Right.
Which would be the S&P 500. They start to pull back and they start to cycle into the life cycle funds, maybe put a little bit of money into the G fund, because those fluctuations now are very extreme. If the stock market drops 10%, 15%, God forbid 20%, then it looks really, really volatile.
Right.
Yeah.
Right.
So let's come back to that.
Okay. So put a pin on that. We'll come back to that. Just getting back to buying stocks. Should I get? Because again, I think what happens is sometimes people get a little frisky, right? They get a little edgy, and they want to have some fun. It's boring to just put money in one spot all the time. So you want to have a little fun. So I want to take my money and I want to go start buying stocks. What do you think of that?
Well, I mean, my dad said this to me years ago. But in my dad's era, maybe I asked him and say, like, let's say it was 1980 and I was a teen, not quite. And my dad was used to buying individual stocks. Mm-hmm. So he told me, I remember him telling me this when I was a young guy. He said to me, son, anybody can buy stocks as long as they're willing to lose their money. I remember him telling me that, and I thought, well, if you buy an index fund, what's the chances of you losing all your money? But in his era, they didn't have index funds. In the 60s and the 70s?
Yeah.
No. The S&P 500 Vanguard fund was released in 1976, and then it takes some years to catch on and become something that is familiar to people.
Right.
And so he was an Allstate employee, Allstate agent, career, life and, mostly auto insurance, actually. And when Sears, who owned Allstate, divested themselves or sold off Allstate, they gave a choice to the employees what they wanted to own. And I think at the time he had Sears stock. And he chose to buy Allstate and AT&T, I think it was, where they broke up what they used to call Ma Bell.
Yeah, I remember Ma Bell,
yeah. And so they broke it up. It was one big phone company. They broke it up into like 5 or 6 companies.
Yep.
I think that might have been in the 70s. I can't remember now.
It was late 70s, early 80s at the latest.
Like
yes.
Yeah. And so I think he bought AT&T and he bought Allstate mostly. And he did great.
Yeah.
I remember my mom saying, your father is such a stock market genius, but he just happened to buy telecommunications, right? And insurance.
And insurance.
Both businesses were pretty good.
Yeah.
Right? All the way up to probably through the 80s and the 90s.
Yeah.
Meanwhile, if you want to go start buying individual stocks, because that's what you asked me, it could be, by the way, to circle back, Dad ended up in the tail end of his life, late in retirement, buying the S&P 500. I remember that. He kept a little bit in stocks, but he had a friend from Springfield, Mass, Bob, one of his best friends, and that's what they did. They bought half bond funds, half S&P 500. And it worked out. It worked out for them because what you're doing is you're spreading your exposure across 500 largest U.S. companies with the S&P 500 funds instead of taking risk with 1, 2, 3, or even a handful of stocks. Right? If one of those is a loser and the other 4 do okay, you're still. A big loser. You could be off by 20% of your portfolio evaporated. Everybody talks about their winners,
right?
But they don't very often talk about their losers, do they?
No.
And I've tried this individual stock before, and I've done really well.
Yeah.
And I've done not so well years ago. So I would simply point out that there's a lot of risk to getting involved and taking your savings and putting it into a individual stock can be tough.
Okay.
It can be tough.
So what strategies could help? And to be clear, we're not doing hot stock tips today, right? No hot stock tips today. That's a different show. That's not us. That's a different thing, right? But just kind of in general, some strategies. If I am going to dip my toe in, I'm going to start investing in the stock market. What are some things that I need to bear in mind?
Well, I think to consider that if you're going to buy individual stocks, you can make a lot and you can lose a lot.
Yeah.
So keep that in mind if you're going to get involved in individual stocks. You hear of a hot stock tip? I don't know, boy. If you haven't heard of the company before, right, and they talk about trying to get an evaluation on the company to see if it's selling for the right increment, right, in comparison. If you don't want to get involved and study and worry, then it might take a lot of risk off your shoulders if you just would go to an index fund instead. Like we mentioned, the S&P 500. At the TSP, you've got the C fund that represents that, right? At your 401k, you've got probably large cap. Oftentimes it'll say the S&P 500 fund, or it might say large cap, domestic fund, U.S. large cap. That's going to represent stocks from the S&P 500. Again, it might be a little more expansive, like the Russell 1000, which would take in the S&P 500 and another 500 companies. But that's an easy way to invest consistently. So if you're going to turn to investing privately outside of your 401k or your TSP, and you have extra money, well, then you might want to think, if you don't want to have a lot of risk and a lot of volatility, you might want to think about an index fund.
Okay.
I would say that's an easy way to go about it.
Yeah. And I think for the average person, right? Because there are people who day trade and that's what they do. And some are successful, some maybe not so much. But that's a lot trickier. You can't just come in off the street and say, "Hey, one day, right? I'm gonna flick on the computer and I'm gonna be day trader."
I don't know. Yeah, I don't know what that's all about.
Yeah,
I want to share something with you.
I would love it. Yeah, I think because we've discussed in other episodes of water cooler talk, right? You hear about that one guy around oh man, I made a killing, and
they never talk about their losers. I'm telling you.
Of course, history is written by the victors, right? I mean, that's the way it goes.
That's right. Yeah. They don't even talk about when they lose.
Yeah.
I want to play this video.
Please.
1 minute. It's from Warren Buffett, and he talks about investing. So
he's done a thing or two with investing, right?
Yeah,
Warren Buffett.
He's done pretty good over time.
He's okay.
He's not so bad. He's not much of a hack. So let's go listen to what he has to say. Okay, we're going to stop the video. It's only 1 minute, but there's some priceless gems in here that I've talked about in other podcasts as well. But sometimes it has more authority when it comes from a guy like Buffett.
It's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund.
He said to consistently buy an S&P 500 low-cost index fund. Consistently. Now, you're going to hear him repeat that word, consistently.
Yeah.
Yeah.
Because, and maybe we'll let that play out, but I think consistent is boring, but boring is good sometimes because that's where the benefit comes in, right?
Well, let's play this some more because consistency might not be boring because it's just fine to be consistent in the good times. But listen to what he says.
Keep buying it through thick and thin.
What? Keep buying it through what?
Thick and thin.
Through thick and thin.
Yeah.
Okay, and especially he was saying, and especially through
thin. Because the temptation gets, when you see bad headlines in newspapers, maybe to say, well, maybe I should skip a year or something. So just keep buying it. American business is going to do fine over time.
Okay, so he says through thick and thin.
Right.
Okay, you know what the thin part is, Mark?
Yeah, the economy's down, the stocks go down.
Yeah, and he even said newspaper. Nobody reads a newspaper anymore. Some do, a little bit, but I mean, we read our phones, we read news articles.
Absolutely,
right?
we do.
And we listen to them, and when the hysteria is going, oh my God, the Dow Jones and lost, the S&Ps, sell. No.
Yeah.
That's when you want to keep investing consistently through thick and thin. Now, this is the thin part he's talking about.
Yeah.
Especially at your work site. If you're in the consistent habit of buying every 2 weeks, right, for federal employees, and most people were buying every 2 weeks or twice a month, either or, right, in your 401k, you keep doing that. On the downside, you're buying with dollar cost averaging, DCA. And so you're buying it on the cheap, on sale. That's what you want to do. I saw a sport coat to buy for a friend. It's a very small sport coat. He's 36 short, little dude.
That's not me.
No, I was at J. Crew, okay?
Okay.
And they move all this stuff to Mission Viejo, shops in Mission Viejo, because in Newport, they're just, Fashion Island, they won't buy anything on sale. So they send all the sale items down by me, and I love it. So I go in there, and I'm like, what? They said, let me ring this up for you. It was, and if you use your actual J. Crew card, another 15% off. This beautiful sport coat was like $275 was $70. Wow. I'm like, wow. I like to buy on sale.
Right.
Don't you?
Yes, absolutely.
Yeah, I love buying on
Absolutely.
sale. I bought a shirt that day for $12.50.
Wow.
One of those J. Crew, really, this
Yeah.
is a J. Crew shirt right here. Love those shirts. They're cotton. It's 100% cotton.
Yeah.
They're sewn well. They're so nice. They weather for years. Several years you can
Breathable,
keep.
yes.
Yeah, just beautiful, right?
Yep.
I love buying on sale. Well, don't you want to buy your retirement investments on sale?
I would think so. Absolutely.
Well, you're not going to be able to time the market.
Yeah.
Don't be so arrogant. Most people just make a mistake on that.
Yeah.
I think it was Buffett's partner, Charlie Munger, who said 95% of investors are going to lose. They can't time the market.
Yeah.
Yeah. In fact, he might even say the same thing as we play the video.
All right. Should we get back to it?
Sure. So you got to buy through all kinds of weather, thick and thin.
Right.
So when it's going bad, you don't move your money.
Right.
Every 2 weeks that you're buying, you don't stop buying the S&P 500. Why would you stop buying the C fund? Your balance, I've said on other episodes, is a different thing altogether, especially if you're getting ready to retire.
Right.
But as for the every 2 weeks, you keep on buying through thick and especially thin because you're buying on sale.
Yep.
Let's hear what he says now.
Time. So you know the investment universe is going to do very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century, and since that century has ended, it's more or less doubled again. American business is going to do well. The trick is not to pick the right company; it's to be, because most people aren't equipped to do that, and plenty of times I make mistakes on that. The trick is to essentially buy all the big companies through the S&P 500.
Buy all the companies through the S&P 500.
Right.
Yeah. Don't try to be a stock picker.
Right.
That's hard. If you're going to, you better do your homework.
It reminds me, I mean, we talk about health on this podcast a lot. It's part of, right, health and wealth go hand in hand. But exercise, daily exercise sometimes is boring, but that's okay because the consistent exercise is where you get the benefits, right? I would love to say I go into the gym, once a month and I bench 400 pounds and I, squat 600. It doesn't work that way. But that every day of going in day after day, that's where you see the results. Is just staying consistent. And it's the same thing. Consistent investing beats that.
Yes. Yeah. No.
Yeah.
Some of you might say, "Oh, I've made some great picks, Charles."
Yeah.
What are you talking about? Okay, good for you.
Yeah.
But for the majority of folks, that's a dangerous game.
Yeah.
I work with some bank examiners that are retired federal employees. And one of them told me to buy this individual stock because he said, I just know it's going to be fine and everybody's crying and whining about it. So I said, are you absolutely sure about this? Yes, I want to buy it. It wasn't for a large portion of the portfolio, but he wanted to buy it. It was shortly after he retired and we created his plan. I go, okay, but you're going to have to send me an email because I'm going to keep record of this, you requesting that I buy this individual stock. So I bought it. A week later, it went bust. And then a week after that, he sent me an email and asked me if I had made that purchase for him. And I go, you asked me to make the purchase. It was in the email, and I told you I don't want to do this, but and he says, well, see, that just goes to show you I'm no good at picking stocks either. And you're right, and I'm a former bank examiner. So yeah, it's. I mean, this is a really smart guy.
Yeah.
I mean, very successful guy, right? And yet, we're all susceptible. We are all mortals.
Right.
Right. So if we spread our risk out across a large, broad index, that's exactly what we'll do. We'll spread our risk out.
Yeah.
And it works great that way.
Yeah.
That's what Buffett just said, right?
Yeah.
You don't do that, but the key is to keep buying.
Right.
Right? And even in retirement, you're always going to need money that's in the stock market for growth. Honestly, even if you're an ultra-conservative investor, the TSPL income fund that says, hey, I'm ultra-conservative, I need this money for income. They're still keeping, what, at least 25%, 26% of your money at risk in the stock market with the CS&I funds. Because you still need growth.
That's conservative.
Yeah,
that's
but
still
they're
growing.
index funds. They're not individual stocks. Yeah, they're index funds. I want to make sure I didn't miss anything.
And I while you consider that, I'd like to highlight something that Mr. Buffett said in that video, which is important if you're considering getting into the stock market, because you've mentioned it a couple times. He mentioned it. I mean, more than most other individuals, has every right to brag about his investments. And he said right there, I get them wrong.
Yeah.
Right. So, I mean, and this is a guy with a lot of money to play with, so he can afford to get him wrong. But someone with a little bit thinner, a thinner margin of error, boy, if you're wrong, that could really hurt.
Well, and he's pointed out that he's really picked, I thought I've heard something like in the neighborhood of 12 really big winners.
Yeah.
Otherwise, not so hot. But you got to make sure the losers don't drag down your winners.
Right.
Yeah, and you got to do your research, right?
Yep.
You got to learn to say no.
And even with all the research, these smart guys are wrong a lot too.
So let's play the last few seconds of this. I want to hear what he says right down here.
And to do it consistently and
To do it consistently.
Do it consistently.
There it is.
Yeah.
Consistently. He said it like 3 times.
Yeah.
Yeah.
Do it consistently.
Do it consistently. Don't let off buying consistently, especially when the market is down.
Yeah.
We're not talking about your balance. We're talking about every 2 weeks.
Right.
Now, I'm going to mention something to you. I have met plenty of people who have taken money outside of their 401k. Maybe you're max funding your 401k. You're doing $30,000, $25,000 a year, and you feel good. Nobody's matching your dollars, and you're tax deferring your money, or you might even be putting it in the Roth TSP, post-tax, which I love. And let's say maybe you're max funded and you can't get any more money, and you're saving, and you want to save more, but you don't want to save it in the bank because the bank might not be making much for you. Mm-hmm. So what can you do? You have a choice. With the S&P 500, the 3 largest funds, which I am not making a recommendation by any means that you buy these funds, but the 3 largest S&P 500 funds, and it doesn't necessarily mean the 3 best, because 2 of the 3 are very low cost, and one of them's a good bit higher, like 3 times the cost. They've all done about the same in the last 5 years. I looked at them, and I want to say Spider has the SPY, S&P 500. It's an ETF. And then IVV is the iShares, right, which is run by BlackRock, and they also run the C-funded TSP. So they've done great, all 3 of these, and also the VOO, that's the Vanguard S&P 500 fund. Now, here's what I want to say. These are ETFs. So if you're going to buy money and it's not in an IRA or a Roth privately, and you're just investing in your own investment account, and you're buying the S&P 500, if you buy a mutual fund, those are separate from those 3 funds.
Right.
These are ETFs, exchange-traded funds. They trade just like a stock. That's very important. What that means is, if you hold on to that ETF for a year or longer, 365 days, folks, or longer, now some of you are holding on to these investments for years.
Right.
If you hold on to them, that's going to be taxed when you sell it off at a long-term capital gain, 15% typically. Or if you buy a mutual fund, you are going to pay taxes on it at the end of the year. You're going to get a 1099.
Right.
Yeah, and in the end, your net effect may not be near as attractive as if you bought an ETF. Because I see a lot of intelligent folks, federal employees, retirees, and private industry too, and even some wealthy folks who will buy a mutual fund. But the mutual fund is not tax effective, not compared to an ETF. You buy an ETF, it's just like holding an individual stock. You hold it and hold it and hold it, and then when you start to sell some of it off, you'll have to pay some capital gains, long-term capital gains. So typically it could be at a lower tax rate. That's the deal. Yeah, so if you're gonna buy individually in just a stock trading account, you might want to get the ETF.
Okay.
Yeah, that's it.
That makes sense because, again, we don't want anybody losing their shirt. And it seems exciting, but we've said it a couple times. The people who brag about this stuff are oftentimes not including all the information about what actually happens to them.
That's right. They're not including all the information.
They talk about the wins. They're celebrating wins.
Yeah,
so
that's right. Yeah.
That's good stuff. So, should you maybe... Definite maybe, but do your homework. Obviously, get educated. And consider the risk. I mean, that's ultimately what it comes. Consider the risk.
Yeah.
All right. You ready for a health tip today?
I am ready for a health tip.
All right.
Today.
So, what do you know about collagen?
I think it's in the Just for Men and Just for Women vitamins, and I like to take because it's my nails have never been stronger. I don't know about my hair.
Yeah.
Yeah.
I'm glad you mentioned that because collagen, so your body produces less collagen as we grow old, and you see the effects in your skin, right? We get more wrinkles, nails get brittle, hair as well. So supplementing collagen can be very helpful. Another one, and this is kind of where I wanted to go because I think most people know about the effects on the nails and the skin and the hair. It's also great for the joints. As you get older, that wear and tear on the cartilage in the joints can make things like standing up from a sitting position, much less walking, challenging at times. So supplementing collagen can also help with that, with joint pain, with keeping your joints loose and mobile, right? And we talk about movement, mobility, health. That's what you want to do. So supplementing collagen can help with all of those things. And it helps with your skin. You have great looking skin, so obviously you're doing something right.
And I got to say 2 things here.
Yes.
3 things. If you're going to talk about skin, it could be genetics, right? A lot of that too. My mom had great skin. My dad's wasn't bad either. Those vitamins I take, I noticed that when you take normal vitamins, and a lot of times when you urinate, it'll be bright yellow.
Yep.
It's not like that with these vitamins. So I feel like my body's absorbing them.
That's a good sign.
That's a good sign.
Yep.
Yeah. Secondly, of the blue zones, there's 5 or 6 centenarians. They live to be 100 or longer. The Okinawans have very little furniture in their homes. And so they suspect that the getting up and down 25, 30 times a day from the floor to an upright position for them at any age, including in their 90s and past 100, could be really good for them. So when you were saying it becomes a challenge to get up and down, it might be a really good idea to practice sitting on the ground throughout your day. And rising, doing one of those Taylor sits like when we were kids in school. Yeah, so far so good. I can still do them.
Keep moving. No, I love it. And definitely the Okinawans are big on the pork meat, so I know they're getting their collagen. They're chewing on
the
those
what meat?
Pork.
Is that right?
Yeah.
Ooh.
Huge of that.
Japanese pork is good. Is
absolutely.
That right?
Yes.
Oh, wow.
Yes, they eat a lot of pork, so
how about that?
They're getting their collagen through their meat, so that's good. That's good.
How about that? Yeah.
Well, fantastic stuff today. I like it. Digging the idea. DIY, do it yourself sounds great sometimes. It's not always. Do your homework, folks. Get someone on your side who knows what they're doing and give you good, sound advice. It's not a no. It's your money. You had that one client. You didn't tell him no. But at least he goes in knowing, and you're not blindly jumping into anything, which you want to avoid.
And it was for a wee bit of his portfolio.
Yeah,
a wee small bit.
A wee bit, yes. Thank you.
Yeah.
And don't be afraid to supplement collagen. The protein is good for you. So good stuff today, my man. Thank you very much for your time as always, folks. We thank you for tuning in. We always want to remind you to subscribe and like these videos. We want to make sure you get this information right to you as soon as it comes out. Also, you have that link below. You can contact CD Financial if you want someone on your side who can guide you through these tough times and help you face it. Well, you got help available to you. I am Marcus C. This is CD Financial Podcast, CD Financial, where health meets wealth. That man is Chuck D. Chuck, thank you for your time, and thank you, folks. We'll see you next time.
CD Financial, where health meets wealth.